So kia ora, ko Michelle Reyes tōku ingoa. I am Michelle Reyes. I am one of the CFA Society New Zealand board members. And on behalf of the board, I would like to welcome you all to our session today, where we're very fortunate to have the lead author of the Mercer CFA Global Pension Index report from 2025, Tim Jenkins, providing us with an overview of the latest report and specifically insights for New Zealand. Before I hand over to Tim, just a few housekeeping issues. We are recording the session, and this will allow people to be able to access it afterwards as well. You would all have been put on mute as you came in. We're going to be making use of the Q&A function for this particular webinar. If you aren't able to see the Q&A function on the bottom of your screen, you should be able to click on the More button, and you would see the Q&A option there. If you really are struggling with that, you can also use the chat function, but we prefer to use the Q&A option. This means that if someone asks a question that you're also interested in hearing about, you can then upvote the question by using the like button, and that will allow us to be able to see which questions we need to get to Tim in terms of the timing that we have available. We are going to leave the questions till the end of the presentation, so I hope that makes sense to you all, and please, we do want this to be interactive, so please make use of that function. Before we get going, I just also wanted to draw everyone's attention to a number of events that the CFA Society New Zealand is hosting over the next couple of months. We've got the Back to Business Summer Networking Drinks. Those are happening in Auckland tomorrow, and I've been informed that that's a very popular event, so I think we're at capacity for that, but if you have signed up, please do go along. And then in Wellington on the 18th of February and Christchurch on the 19th of February. And we still have space at those two events. So I'm more than welcome to join us there. We've also got the Conference Keynote Lunch and Learn series, where we're going to feature a presentation from Dr. Pippa Malmgren, who spoke to us at the CFA conference late last year. And there'll be a discussion facilitated by our board chair, David. That's happening on the 26th of February in Auckland. We've also got an event on the 4th of March in Auckland for CFA Society members, where we're going to introduce the CFA Institute Inclusion Code for Aotearoa New Zealand as part of a visit from our UK colleague, Sarah Maynard. And then last, but definitely not least, is the very popular signature event that we host every year, the Forecast Lunch, which features the forecaster of the year. And this year, we're also having a panel discussion on the evolving landscape of KiwiSaver, which is very topical at the moment. This is always a very popular event, so make sure that you secure your spot for the 24th of March in Auckland. Right, so time to get into the detail of the report, this Mercer CFA Global Pension Index report with Tim. Tim's an experienced actuary and a superannuation professional. He's a partner at Mercer Consulting in Sydney and leads Mercer's Australian superannuation consulting team. And Tim tells me many years ago he was actually the CEO of Mercer New Zealand, and he spent 6 very happy years living in Auckland. So he does understand the environment in New Zealand particularly. He's a fellow of the Institute of Actuaries of Australia and has been a chair of the Actuaries Institute Superannuation and Investment Practices Committee since 2018. As I mentioned before, Tim's the lead author of this report, so we are really looking forward to having him share the insights with us. Over to you, Tim.
Thank you, Michelle, and hello, everybody. It's a real privilege to be here, and this is the first year I've been the lead author of the Mercer CFA Institute Global Pension Index. It's a real honor, and it is really interesting doing this job because it's all about how do you compare retirement income systems around the world, noting the fact that retirement systems are structured differently in every country. There is no lookalike system. So let me head into what the index is about. And I'm looking forward to the Q&A at the end, in particular because one of the aims of the index is to benchmark and compare retirement systems around the world with a view to helping different countries enhance the systems to improve the retirement of individuals in those countries. And I can't help but note that in New Zealand, a retirement phase is something that is in the media a fair bit and mentioned by the politicians. So hopefully this goes some way that you think about, do we change KiwiSaver? How do we change it? Do we change NZ Super? So let's head in to this. So as I mentioned, retirement systems do vary around the world, but it doesn't mean that you shouldn't compare them. The World Bank model is at the essence of how we look at the systems, the five-pillar model. It used to be three, expanded to five. So if we look at the left-hand side, pillar zero, that is a basic public pension that provides a minimum level of protection. Think NZ Super. It's not minimal compared to some other systems. It's okay. But that's pillar zero. Then we have something like pillar one, a public mandatory and contributory systems linked to earnings. Number two, pillar two, a private mandatory and fully funded system, and three, a voluntary and fully funded system. Now, KiwiSaver is probably a 2.5. Can I call it that? Because every system is different. We've got an opt-out system with optional higher rates is like pillar three, but we've got minimum contributions, which is like pillar two on this. And of course, look at pillar four as well. You need to look at household savings as well. Who's got money in stock markets or investment properties, etc. on there. So the approach there recognizes the different features of a retirement system around the world. So let's look at some of the examples beneath that, which vary from country to country. If you look at many European systems like France, for example, everything's public. There's not much private on there. Do you pay pensions? Do you pay lump sums? Is this a savings vehicle or is it a retirement income system? Think about the difference between those two things. What is the psyche? Do people look at what is my account balance going into retirement, or do people say, actually, I've got $10,000 a year is what that can buy me on this? Is it funded? Is there money there? Or is it pay as you go? Book reserves like Germany, for example. Is it defined benefit? Some countries still are on the defined benefit pathway. New Zealand very much not. Or is it defined contribution? And then in the private market, is it employer-led? Is it insurer-led? Is it fiduciary-led? It's different systems in there. And many countries like Ireland are still very much in the world of employer pensions. Your workplace gives you your pension, with your employer the identity. Whereas in New Zealand, for example, it is the KiwiSaver system that does that, fiduciary-led on there. Is it tax preferred or little tax advantage? And we'll head on to this, but New Zealand is one of the countries that has one of the least tax preferential treatment for retirement savings in the world. Ones that maybe have even less are the Middle East, where people don't pay tax. So there's no tax saving to be had for putting money around for retirement savings. The coverage levels, is it all the population? Is it the expats? What do you do for people who are not in the workforce? What do you do for people on carers leave, people on disability? There's a number of things. The self-employed, are they in, are they out of the system? And then it leads on to how large are the actual pension funds or savings vehicles. The larger the vehicle, the more sophisticated the investment structures are able to be, as you know. Retirement ages vary considerably around the world, as does longevity, life expectancies, and the financial position of the countries varies as well. So you can see it's very different as you head through everywhere on this. But doesn't mean you shouldn't compare, and hence for the last 17 years, Mercer, now with the sponsorship of the CFA Institute, has been preparing and communicating the Global Pension Index. And New Zealand has been in the index for the last 9 years. So the way the index works, and I'll come on to some of the mechanisms here, noting it's the CFA people I'm talking to here, so you're probably really good with numbers and the way you analyze. There are 3 different sub-indices which aggregate towards the Global Pension Index. And they're weighted according to the influence that has perhaps on individual retirement outcomes. So the first one is how much, the adequacy, what benefits are likely to be paid. The second is sustainability. Can existing systems keep delivering? Can you afford them? And the third is integrity. Is there confidence in the system? Are you disclosing what is happening? Is that there for everyone to look at? So they're the three components. Now, what we try and do as we put together the index is to use objective public information rather than subjective information, although there are some subjective elements that you do need to have, but they are difficult to measure and difficult to compare. So we tend to use information from international agencies, the IMF, World Bank, OECD data as the core source. So it's not possible to game the system on this. We also use in the 52 systems around the world, which are now in the index, which is 2/3 of the world's population. You see them on the map here on this. We use experts in there who are not actually in government, part of the regulator, because we want to have an academic sort of person outside in, whether it's a Mercer person or a specialist in the countries to actually confirm what we see. There's about 60 questions which go into the index, and more than 50 indicators are used. There are some subparts to that. The big point here is the index is comparative and relative. It is not absolute. So it's a way of having a grade for a system, and we pay more attention to the grade than actually to the score, because plus or minus two, the way you look at a few of these things, you know, it could be how you interpret the data or how information is presented by those external parties. So we're pretty clear if you've got a score of 75 that your system is probably a better system than one with a score of 70. But if there's a difference between 72 and 73, it's almost arbitrary how those things come through on there. In some of the countries now in the index, we can't get OECD data, so we do have to recognize the fact some of the data is not available for every system, and we estimate things like net replacement rates in countries like that. So that's the way it all works through. It's been going for 17 years. And you see New Zealand on the bottom right with a B-rated system, a B-grade system on there, which is a good system, but one where there's the possibility of enhancing some elements to improve retirement outcomes. So what I'm going to do in the presentation after this is show you where everybody sits, and then I'm going to be heading in to go through what was new in the 2025 report, and then having a bit of a deep dive into the three sub-indices with a New Zealand lens. So adequacy, sustainability, and integrity. Michelle mentioned the fact that 20 years ago I was in New Zealand as CEO of Mercer New Zealand, and I learned then, with my UK background, that in New Zealand it's quite common to compare how do we go against Australia, how do we go against the UK. So I've actually shown with the box there where the grades are for those other two countries as well as New Zealand. The New Zealand score at 17.4 is grade B. In fact, New Zealand, and I'll come on to that, has been grade B all the way through its 9 years of the index. Its position has changed as more and more countries enter the index, and some of the data changes there and some of the things that go into the metrics. Again, I'll come into some of those. So New Zealand is top third, just when you compare all the countries. Grade B, room for improvement, but pretty good. I had to do a presentation last month to India. That was a bit more testing. Look down there, India is the lowest graded system at grade D. There is no E-grade system overall. 35 is the score to reach grade D. There is no system overall that is grade E, but some of the sub-indices are, and we'll come on to those to look at that. India's got some very particular issues because the workforce there is often not organized. And you can imagine there's one system for the government people, and there's another for a few private sector, and there's the disorganized sectors there, and that's really difficult to deal to. So what's new in the 2025 report? Most years we add extra countries. 4 was the most we've ever added in 1 year. We took the plunge. And the 4 systems added were Kuwait, Oman, Namibia, and Panama. We're looking through now the 2026 new entries, and Kenya is the one that is in already, and we'll be thinking of some other ones. We haven't had any country drop out of the system yet, but at some stage that will probably happen because you need the data and you need a sponsor, an expert to give you that information. We did get updated data from OECD and IMF, which are quite pertinent to the scores. The Asia Pacific scores varied the most this year because the updates to OECD data coming through, that made a big difference in markets like Hong Kong, where the net replacement rates went up significantly. So there's always movement. The OECD data refresh is a big one, but also growth rates in the economy, things like this change. And in 2025, the way we look at the growth rates in the economy, which is very important for sustainability, we do a 4-year backward look and a 3-year projected look, and have an average, thinking what the growth rates look like, which meant that a COVID year dropped out of the figures, which helped many of the systems get a slightly higher score in 2025 compared to 2024. In fact, we had 9 systems improve their grade, whether say from B to B plus, B to A, etc., and no one went backwards. What we also do for the last few years is we have a feature chapter on something which is pertinent and makes a difference to retirement systems. And in many countries around the world, the governments have started to look at what should I be expecting on the investments of my private pension funds? Should I be requiring investment in things which, if I can use the phrase, are in the national interest? And then if that is the case, how does that square away with the duties of running private fund? If I'm a trustee and I'm looking after member best interests, what do I do? What's the balance? And hence the feature chapter, and I'm going to work towards that at the end of this presentation and just walk you through some of the headlines, where we ended up in the feature chapter putting forward 8 principles to be considered by the government's regulators and the pension funds themselves to try and get the right balance between those 2 issues. So what I'm going to do now is go through the adequacy index, the sustainability, and then the integrity. I'm going to have a bit of a flavour on New Zealand, talk you through some of these, talk about some of the other countries, and then we'll start to pull that together and go through, well, what could be done if your aim is to improve the grade in New Zealand. If that is your aim, to go from B to B plus or B plus to A, what are the levers you could pull? What would that be? And nothing here is concrete. You can imagine some things are not in the control. So on adequacy, there are many metrics. The 3 ones that make the biggest difference overall are the level of base pension paid, NZ Super in New Zealand's case. The second one, net a replacement rate. And the way we look at that is a weighted index where we put a 60% weighting on the income in a retirement divided by average earnings for the average earner. And then we have a 30% on someone at half average earnings and 10% on someone 1.5 times average earnings. So it doesn't look at the top decile income earners when we look at net replacement rate. This index is very much aimed at the average person, the typical person going through, not the wealthy. Probably pillar 4 comes in more for such people. And then the third bit is system design features, 25% in aggregate, lots of different questions. This is things like, does the system require me or encourage me to take some of my retirement lump sum nest egg and actually make that an income? Can I just take that as a lump sum? Is there preservation? Is money locked up until retirement, or can I take that money out of the system? And are there incentives that encourage me to save? So let's think about some of those in the New Zealand context. The figure for NZ Super is 39.7% of the average wage being paid through New Zealand pension. That is a pretty good score compared to many countries, but not top score. Many European countries have this, and the target there is often a combined figure going through of about 70% net replacement rate. The base pension comes into that. In New Zealand, the net replacement rate weighted is 51.1%, with NZ Super the biggest component of that. KiwiSaver's coming in. The KiwiSaver figures there will increase as the contribution and contribution match goes from 3 to 3.5 on 1 April and progressively up to 4, I believe, in a couple of years' time afterwards. But there is a discount there because money can be accessed earlier for certain reasons, like housing popping through. So we try and get a weighted figure through there. And then when we come to the system design features, I mentioned this if I was presenting to the NZ Society last year, that what you have in New Zealand with KiwiSaver is a retirement savings system, not a retirement income system. That's the same in Australia, really being tried to change. It's a big thing going through with the changing demographics and the silver tsunami, as it's called, with 2-something million Australians about to enter retirement phase in the next 5 to 10 years. And the system really isn't working well, and the regulators are really keen to enhance what's happening and transform the defined contribution first-class accumulation system into a retirement income system. And incentives. There aren't many tax incentives in New Zealand, as I mentioned. Philosophically, since 1990, that has been the case. One of the questions there is, could there be incentives? Could there be things put in subject to affordability? There is a 10% weighting as well to levels of household savings and household debt. Like Australia, and New Zealand has got relatively high debt levels for a household. I think it's 90% GDP debt levels and minus 4.6% in savings, not a plus on that outside. So they're relatively low. Home ownership is average compared to many of the countries in the index. Growth assets is important here because if everything is invested in cash fixed interest, in the private sector savings like South Korea has been historically, you don't get the real growth. It's about 54% average in the KiwiSaver world, which is pretty good. That number is higher in markets like Australia, that's 70% on average on those markets. So the winning countries are new entrant in Kuwait, Netherlands, which is the overall #1 country in the index for the last 3 years, and France, all have very generous, adequate benefits put together. It's interesting, actually, the European countries here, there's a plethora of countries with an A grade for adequacy. The issue becomes sustainability, affordability, really, on there. So France Spain, Austria are all A-grade adequacy, but E-grade sustainability. There are real questions as whether the government can continue to afford the pensions. The cost of paying the pension as society ages is becoming severe. We've all witnessed the strikes in France when the age pension was looked to be increased, I think, from 62 to 64. No one was having any of it. So there's some real issues in some of the countries, and it's trying to get the balance right between adequacy and sustainability on that. And New Zealand's there at 65.2, which is middle range B, quite a way to go on adequacy compared to European countries heading through on that. Moving on to sustainability. On sustainability, there are very few countries with A-grade sustainability. There are only 5. The 3 shown there, Iceland, Denmark, Netherlands. I think the other 2 from memory are Israel and Australia on that. The metrics for New Zealand, which come into the New Zealand rating of 68.2, 20% of this is on the coverage of the funded pension plans. New Zealand's actually pretty good. There are bits, because everyone is able to join KiwiSaver. Kids can join, people out of the workforce can join. So actual coverage is not bad. There's a different issue when it comes to the contributions that go with that, because there are many people who do not get those contributions, and you need an employer match. So you need to pay to get the employer match, and there's opt-out. 15% rating there to the level of pension assets as a percentage of GDP. New Zealand's at 48%. By comparison on that, Australia's 140%, to give you a feel. Once you get beyond about 50% of GDP, the pension assets start to influence investments in the country concerned, and governments often get more interested in how pension funds invest. Demographic issues, the other 20% on there, that's old age dependency ratios, normal retirement date, longevity, where is that heading and what does that look like in future? And at age 65, NZ super date, I believe longevity is about 20.8 years on average, and that's projected to increase by about 3 years over the next 25 years. So there's different stats in there which influence where that heads. And the other one that comes in there is low fertility rates, which will change the old age dependency ratios over time. People live longer, less people getting born on that, which influences public pension costs. The cost of NZ super, as we measured it for the index for 2025, was 6.1% of GDP. That is a lot lower than many of the European countries, which are double digit. In Australia, with the means tested age pension, that's only 2.2%. So you can see why Australia has an A-grade sustainability, perhaps. The private savings there, in effect, mean that less people get the Australian pension because it's not means tested. And I mentioned about economic growth there as well and where that sits. It's average in New Zealand compared to the systems around the world. So that's sustainability. So it's 40% adequacy, 35% sustainability, and the third one, integrity, where New Zealand gets a great score. Many countries get a great score as well, as regulators, legislators look for systemic transparency. If I were to look at one thing that perhaps could be improved for the New Zealand system, it would be the fact that trustees may choose to have certain policies, but don't have to have policies in things like risk management, conflicts of interest, code of personal conduct, anti-bribery. Little things like that at the edges, but it's a good score. And you see, whilst there's room to go up, it's over 80. 80 is A grade on that. So I'm not going to be focusing much on integrity for New Zealand. Mentioned New Zealand scores haven't changed much over the 9 years, remain B grade on that, up and down depending some of the data, went from OECD, whether that is from alterations to things like private household debt, growth rates, etc. It was the growth rate that enhanced that going through for 2025 over 2024. But there's still a bit of movement to be done, 5 points to get to be a B plus, but pretty safe from falling down to be a C plus, the next one down. So it's, it's staying pretty static, reflecting the fact that things have changed a bit on KiwiSaver at the edges. The demographics have changed, but not materially compared to some other countries. We've got countries like Japan, South Korea aging faster than anywhere else. So I've got a comparison slide here. I mentioned at the start that one thing I did learn 20 years ago is it's really good to compare to some other countries like Australia and the UK. So you can see here the scores for New Zealand as a whole and for UK and Australia. The New Zealand score is 31st out of 52 for adequacy, 11th out of 52 for sustainability, 16th out of 52 for integrity, but an A grade, lots of good scores on integrity. So you can see the conversation about where you might improve is very much focused on adequacy and sustainability, which I think goes into some of the political debate that you've been seeing in the last while for what's the way forward for retirement income systems in New Zealand. So I'm coming on now to just focus firstly on adequacy, then I'll go on to focusing on sustainability. So the first one there is, how do we increase the net pension replacement rate? I mentioned that the NZ Super at about 39–40% of the GDP is a good component of that. The score there, 6.2 out of 10. If you had a net replacement rate for the average earner of 70%, you'd be coming in at 10 out of 10. Anything more than that is good. If you get one that's too high, it starts to go backwards. You can actually be putting too much money into retirement phase rather than living your best life before retirement. You've got to get the balance right on these different things. So this is one where an increase to the KiwiSaver rates will start to make a difference. You need to think about where that falls in terms of if NZ Super remains universal, not means tested, what level should that be at? Remember the Australian system at 12% with no requirement for an employer contribution. So more people, and you can't opt out. For Middle Australia, we're now getting to the phase when Middle Australia retires. If you're now in your 40s, the expectation is you won't start with any age pension. You'll get that over time as you start to spend down your superannuation pot. It makes the system in Australia very sustainable, but in one sense, a saving at 12% super guarantee is replacing the age pension as opposed to supplementing the age pension. So just something to think about as New Zealand looks at this for the future. That's why the Australian adequacy is not high despite the 12% rate. It's the combination of the two. It would be great if we look at the economy and the position in many Western countries, the savings rate is not great and the household debt to GDP ratio is large. There are larger rates in other countries, but you look at that score of 1.6 out of 10, that is pretty low. On that, there is room over time as the economy improves, the households feel more confident, cost of living pressures change, you might get different outcome coming through on that. New Zealand scores low on the next two ones are incentives to save for retirement. The government co-contribution is being cut back over time. There are limited, virtually no tax concessions for KiwiSaver. Many other countries incentivize retirement saving, whether it's deferral of tax, so you're paying no tax at all until you draw your money out, and then it's fully taxed at marginal rate. Even better, there is no tax on certain components of that. There are different ways to look at the world. It's not saying what happens in New Zealand is good or bad. It's just different. Um, and where there are incentives, that does help adequacy. I mentioned the income stream requirement, question mark there. If there were ways to default people, encourage people, and opt-out type system to have more taken as retirement income. And New Zealand does not have much, if any, annuity-based payments from memory. There really isn't the positioning there for KiwiSaver to do that. That is something compared to the world that systems like Australia and New Zealand are behind. And then there are certain cohorts where, say, I was going to Scandinavia, the Nordics and Netherlands, who perform really well in the index. There are systems there where contributions are paid for people on parental leave, carers' responsibilities, on invalidity, disability. Money goes in to the savings pots. There is more, what can I call, socialism, perhaps, in the way things are looked at in those markets. It's not about my super, it's about our super, our retirement savings on that. And that's quite a difference in the mentality that you see in Australia, where it's very individual and how some of this comes together. Moving then to sustainability. I'm just looking at the time, so I might go a little bit faster here so we can have some Q&A when we come on to talk about the special chapter. Assets in KiwiSaver and the remaining few superannuation schemes outside the government sector, we don't look at the government ones here, 48% of GDP in New Zealand. That compares to 140% Australia, 82% UK, which is like a mid-score on this one, and that's quite an important part of the sustainability. If you've got real assets there, that helps. In Germany, there are lots of private pension funds, but their book reserves, there's no money there to support that, which creates an issue. There's a bit of a risk there if employers aren't able to deliver on the promise of their workplace savings on that. Life expectancies are increasing around the world. New Zealand life expectancy keeps going up and is scheduled to go up further over the next 30 years. Yet some countries have legislated for an increase to the state pension age to accommodate increased longevity. Something to be thought about that impacts significantly on affordability. And also the funded level of contributions, the more that's funded there, the more money is there, the more sustainable that the savings are. So there are 3 ones there which have meant the New Zealand score is 17th on sustainability out of 52, right in the middle. 11th, as opposed to a higher score that we saw in some of the other countries. Okay, quick pause on those, and I'm going to move now to the special chapter, talk through why we did the special chapter, and then lastly finish off with what are the 8 principles that we have to get the right balance between the influence of the government on how pension funds, KiwiSaver type funds invest, and the government national interest on this. So, governments are trying to influence this. The more that they see pension funds have as an asset pot, the more they look at some of the issues they're facing in the markets that they have themselves. They're saying it's all very well that we have encouraged private sector retirement savings. Often we give an incentive, but shouldn't we demand something back for that incentive? We want things which help us grow as a society, because after all retirees will be in our society. So they're not independent of each other. So the more that I can do things which encourage pension funds or require pension funds to invest a certain way that benefits the country, the better I'll be, the better my pensioners will be by a different route. So that's the philosophy. The reasons that we came up with this one for the year concerned is that in two markets that I've just mentioned, they're really getting mentioned. I'm sure, as you heard from Michelle at the start, that's the case in New Zealand too. In Australia, Jim Chalmers, the Treasurer, is looking at how can I encourage social housing investments by super? What can I do to change the dial so that I deal to the housing crisis that we have? How can I make sure that the pension funds are investing in infrastructure projects that I want invested in, things that matter to me as the country, as opposed to ones that might be the best return, if I can put it in some of those terms? How do you get the balance right? What do I require on those? And in the UK, a mansion house has been legislated, and pension funds must now, I understand, allocate 5% of investments to UK private markets. So you've got those different bits there, which are looking at how do I develop domestic markets using pension fund assets. And when we look at how that happens around the world, there are many systems which are principles-based, high-level frameworks like a prudent person. That's how a pension fund should invest. EU is very big on those sorts of things. For example, you get different principles there. I must invest in the best interests of the members concerned, must be looking for best returns, but cognizant of risk, looking at the liability structure. If it were defined benefit, for example, you'd invest differently from defined contribution for those funds. So we have in the special chapter a whole lot of principles, a high-level frameworks, which shows what has happened around the world. That is pretty common. And in the top systems in the index, generally that's as far as it goes. There are very few caps, restrictions on how pension funds invest, with the exception of in-house assets, which are when you invest in the assets of the sponsoring employer. So if you have an employer plan, if you have all your investments and shares in that company, it goes belly up. Your employees lose their job and they lose their retirement savings at the same time. So that's why there are most countries, 41 out of 52, there are restrictions on house assets where employers have a significant role on that. But there are things like caps, restrictions going in, ceilings on asset classes, like in India and Turkey, you're not able to invest in direct property, pension funds, restrictions on foreign investments, things like in the US, or if you're a US company overseas, you cannot invest in sanctioned countries, and that goes in many markets on there. Regulated markets too, you can only invest in a regulated market. That's quite common in EU. In France, 30% of your investments must be in regulated markets. Other types of restrictions, one's on membership profile. We've got countries like Mexico, where your investments must be linked to the age of the member concerned. So an older member would have less in growth assets as part of the restrictions that they require on that. Many countries have restrictions on the voting rights. In Canada, it's going to get rescinded, but at this stage, you're not able to own as a pension fund more than 30% of the voting rights in one of the corporations on that. And that's very pertinent in Canada. Many of the public pension schemes there are very large and therefore do control aspects of the entities. Some more so things have moved towards indirect influence on them. There's a list through there. I won't necessarily go through all of those in the time. I'll give an example in the Australian market where the investors in Australian shares benefit from the dividend imputation and franking credits, which encourages the super funds to hold more in Aussie shares than they otherwise would. Whilst there's an increasing investment in overseas shares, private markets, etc., there's still an influence on Australian shares because of that. It's disproportionately high as part of the asset allocation as a consequence. You have caps on fees, which can restrict how you invest. And one of the examples that I can think there is master trusts in the UK with a very tight fee cap, which is constraining investments in infrastructure, things that might give a higher net return. But if there's a fee cap on what can be charged, certain investments are more expensive, and therefore super funds, pension funds are very reluctant to invest in that because it really constrains them on the other parts of their asset allocation. And then you have things like other considerations, the ESG factors, how you fund DB versus DC can actually influence certain things, certain preferences that you give. Risk-based levies like pension protection schemes, compensation scheme of last resort in Australia. They influence how you invest, and they can attract or make it worse for you how you invest. And there's a solvency test which might give you more flexibility if you are fully funded versus partially funded in the way you invest your pension fund assets. So lastly, just coming into this, here are the 8 principles that we headed through and came up with, which is actually really helpful, we find, in the discussions as we go through the various countries. Again, no country's in the same situation on this, but here are 8 principles to try and get the balance right between acting in the broader national interest and acting in the best interests of private pension plan participants. If you look on the left-hand side, there's probably no surprise for New Zealand. You'd be looking at this and we'll be saying, well, our primary purpose is retirement income for people in KiwiSaver. Retirement first. Best interest of the beneficiaries come first. Integrity of the trustee. That's what trustee does by its very nature. Robust governance, comprehensive investment policies, sound investment governance, tick, tick, tick. And full market access as well. Where can you invest? Very few restrictions on that, but it needs to be appropriate to size and complexity. Developing economies, probably you'd expect more focus on the national interest because that long term will lead to the sustainability. So that's point 8 on this, the macro awareness. And New Zealand is at 48% of GDP for the private sector pension savings, KiwiSaver savings. That's right on the cusp, we think, of where this really starts to make a difference. The more you have there in that, the more that pension fund assets make a difference to what happens in the market, and the interaction between fiscal and social policies has the implications for people in retirement. Need to get that right. Scale, I'll just put in that one as second to last one, collaborative scale. Give the example of Ireland. There are lots of private pension savings, but they're still relatively small pots. So there needs to be a way for how do the pension funds collaborate with each other or with the government in public-private partnerships to increase those investment opportunities, particularly unlisted alts infrastructure on those. And then lastly, I can't help but leave with this one, New Zealand environment, where are there policy incentives of things like how do I tax incentivize? How do I contribution incentivize? So whilst investment decisions can be left to the pension fund, are there ways that I can make certain things more attractive to actually influence how things are invested? So that is a thought. New Zealand does probably have more savings overseas than other markets, as you might expect, but there could be things that are done which encourage more investments in New Zealand. So, Michelle, I will finish here, pass back to you. I did talk for a little bit longer than I thought on that, so my apologies, but hopefully we've got 5 to 10 minutes for questions on there. Thank you.
Great. Thanks very much, Tim. Yeah, so I've been monitoring the Q&A. It doesn't seem to have been people putting that in, so I don't know if that was a technical issue. If you do have questions, you can also pop them into the chat. So we've got about 5 minutes for questions. So if anyone wants to quickly put something into the chat, I'm happy to pose those to Tim. In the meantime, Tim, you're just going to have to deal with questions from me because it looks like we've got a little bit of silence from the participants. And I guess maybe just touching on what you were raising as that last thing about the sort of balancing between investments in the local market versus the national interest versus the interests of the members. One of the things within the New Zealand context, which you would obviously be aware of, is the small nature of the market here. And when we look at things like the diversification of portfolios. Is that sort of a consideration that you looked at as well? Because, in addition to the return kind of criteria, one would hope that people would be diversified. New Zealand's a small economy. If there's a shock here, if pension assets are invested overseas, at least that's less of a shock for people to endure.
Absolutely. Spot on. So we do that two ways. One is we look at the percentage of overall assets in growth assets versus defensive assets. That's one of the lenses. So that's a higher level lens on that. But then we also, behind that, start to look at how things are invested, the asset allocation, the diversification in that. Because of the way different markets work around the world, though, if we had too much concentration on that, it makes it hard when you have the European systems, which do not have any savings at all. So there is a weighting, but it's relatively low. It might be 5% of the sustainability as opposed to a higher weighting for that a reason, Michelle. We have to look at the variation in the systems around the world. But of course, it does go to the heart of this. And as you will be looking at how do I adapt and grow the New Zealand market, as more assets are held by the KiwiSaver funds and other investments, you would expect more diversification. We've really seen that around the world. In the movement, particularly between private and public. If I use the example from the Australian market that I'm very familiar with, the assets in superannuation are more than the whole ASX. They are more than GDP. There is a requirement to find other markets, even if it weren't for diversification principles of getting the best return through there and a safety for members on that.
Great, that makes good sense. Okay, we still don't have anything coming through, so on with my next question then. And I suppose this is something that we had a bit of a discussion about before you did this webinar. This idea that as we start to rely more on workplace-based schemes for retirement savings, for instance, KiwiSaver, this is obviously tied to people in more traditional wage and salary jobs. And how are the countries that are doing well addressing the issue of the gaps that emerge when you've got time out of paid work for people, caregivers, you've got people who are perhaps on low incomes or in non-traditional jobs like gig workers and things like that. How are the kind of the leaders in this field, what are they doing in their systems?
Michelle, that's a great question, and it's one that we ask in Australia all the time because you think Australia is a universal system, but there are definite gaps. A carer's pension doesn't exist, right? So if I'm out of the workforce for a while, it's just starting now. We're about to have in Australia a payment for people on parental leave. When you get the minimum government payment, the government will pay a superannuation contribution on that. But it's nothing like the levels that would be paid in Scandinavia. In Scandinavia, there's an understanding that society expects that payment to be made. It's actually a real issue all around with this defined contribution often being based on what you earn. Some of the countries have a minimum level of contribution regardless for everybody, which really helps. You can imagine the low paid people not paid to have a contribution going into their savings. New Zealand, with the KiwiSaver requiring an employer match, is not a system that exists in every country. Some countries, you don't have to pay. The employer must do this, or the government must do this. And that's an interesting one. I know as you look at the market through there, particularly when you have things like total remuneration structures. Am I really paying my own employer contribution? Australia has that as well, a total REM structure in many employers, but 12% super has to be paid regardless of whether you contribute or not. So there isn't the people saying, well, I'm not paying because really I'm paying 7% myself rather than 3.5 on that. So yeah, it's a fundamental issue. There's a real issue though on the self-employed. What do you do there? Should you be requiring people to save? Should you be encouraging people to save? Are there any incentives for those people to save? It's an open question for how those things go, particularly in markets like New Zealand, where there is the fundamental thought you should let people choose. The concept of perhaps I, as the individual, should know best on this. What should the government tell me, as opposed to what can I choose to do? So opt out is really a nice way to do things in societal structures like New Zealand and Australia, where that happens. So I haven't quite answered everything, but it's a real focus here. The coverage rates are not as high as they should be. And even more so, the contribution rates going in for these people with the gaps. There is a problem when you get to retirement phase, if people are not contributing in these more frequent career gaps that we can expect, particularly with the Gen Zs coming through, etc. A whole portfolio of jobs. I'll do a gig job. I'll do 6 jobs at the same time. I'll do nothing for 6 years, etc. I'll stop there because we've hit time, but
we've hit time. Yes.
It's a great question. It's a good one.
Great. Thanks, Tim, and thanks very much for your time, and to everyone who's attended online. Just also for those of you who came into the room a bit later, just a reminder that we've got a number of events happening from the CFA Society in New Zealand over the next 2 months. All the details are on the website, so please sign up for those. And thanks everybody, and have a good afternoon.